Hey traders, welcome to our Sunday live Q&A show, which is basically called our Sunday live Q&A show. Hope everyone is having a good weekend. Getting away from the charts for a little bit, and we're starting to refocus on what we have in this coming week. On Sunday evenings, I prepare, and I do that here with you all in my office. And the goal here is to make sure that we have a plan in terms of a watch list, in terms of some directional bias, and we have a plan for open trades as we go into this new week. A couple things to kick off the discussion is, first of all, when we're talking about a new week, probably one of the most important and often overlooked things is in terms of what are we looking at, what are we focusing on. A lot of times traders are, I'm going to grab the calendar here, there we go. So one of the things that traders tend to overlook is what type of events could increase the volatility of the week. Now, granted, there's two things I want to look at in terms of volatility. One is, what is problematic volatility? No volatility is no good. I mean, how many times have we been sitting around waiting for a pullback in an overall market or waiting for follow through after we put on the position? That is a type of volatility. The volatility that we all kind of hate is the above average volatility, when we're expecting a certain amount of price movement range and we're getting far more. And that's exactly what we're getting. So there is typically a 68% probability for a certain number of points in any kind of market. That's usually the behavior 2 out of 3 times. Every now and then we're going to have this rare air, which happens, basically 1/3 of the time. And you might say, Rag, how do you know that? If you go back in terms of historical volatility, if you go back and look at the behavior of any symbol individually for the last 4, 5, 6 months, you'll see there's a certain amount of movement it typically has. You crunch it through a little bit of math, and out you get a 68% probability of the typical price movement range, which is why I call them daily price movement ranges and hourly price movement ranges. And we'll get to that in just a bit. I'll show you what that looks like. The reason we would stay inside the daily price movement range is there's nothing unusual that has to be factored into the market. Another reason we might move outside of that range is there's a new bit of economic information, geopolitical, political, just some sort of headline, some sort of soundbite that, again, has to be factored in or discounted into price action. On Monday, tomorrow, we're going to get core retail sales. All right, why is this important? Any metric that's asking what is the health, what is the activity of the consumer is going to be really powerful right now. It's going to be important to watch. So does the consumer have a job? That's employment. Is the consumer buying a house? That's existing home sales and new home sales. Is the consumer buying things? That's going to be retail sales and core retail sales. Does the consumer feel that at the moment they can stay employed and buy things? Are they feeling optimistic or not about the economy, about their employment, about whatever the outlook is for their financial future? That's all these different sentiment reads that we get. So we take a look at, is the consumer doing anything? Employment, buying a home, buying stuff. How are they thinking? How are they feeling? And then we look at different inflation metrics. Now, tomorrow we get the consumer version. That's the retail sales. We go into the rest of the week. You'll see that going into Tuesday, pretty quiet, but we get that housing information. So that is the consumer buying a house, building permits, housing starts. All right, fast forward into Wednesday. Boom, we've got the FOMC statement, the presser. All right, wait a minute, Rag. Isn't this the most important event of the week? That it is. That it is. So let's go on over to, and I want to mention the other ones because it's so easy just to say, wait for the Fed, but there are all these other stepping stones along the way. And yes, consumer retail, consumer home buying, that could be important, but obviously will be eclipsed by the meeting that we're getting. Okay, so is this meeting a big deal? It is only in that anything that's in the press conference and anything that's in the rate statement could begin to clarify expectations, not about any action being taken on the 19th of this month, not about any action being taken on the 7th of May. And frankly, this meeting is about the 18th of June. The 18th of June has a 70% probability of a quarter point rate cut. So this is not about are they going to cut or hike on the 19th? They're not. They're not going to do anything. They're going to. What we're hoping as traders and investors, for clarity's sake, is if we have discounted on 18th June Fed fund futures that there's going to be a quarter point cut, we want to see the wording in the statement and the phrases and the answers in the press conference that keep us collectively believing that this is the most likely outcome. That's really it, gang. That's really it. So think of it this way, because if it feels a little confusing, let's say you're looking at supply and demand for crude oil, and there's an OPEC meeting, right? We know OPEC is essentially the central bank for crude. They turn the spigots on, they can turn the spigots off, right? When we know that they're going to change their policy about crude oil output, well, it's pretty easy, right? More output typically lends itself to lower prices, right? More supply is typically bearish. And if they're going to turn the spigots off, less supply is typically bullish, right? So we know the basic economic one-on-one of supply and demand. Supply is resistance, supply is selling, demand is buyers, demand is a floor, demand is support, however you want to look at it. Same thing goes with the Fed fund futures. So instead of crude oil, now we're talking about Fed fund futures and what are we anticipating? There's a futures contract dedicated to it. That is what the next two meetings, frankly, not just March, but also the May 7 meeting is all about. And so you'll notice, yes, we skip April, and that's going to be where the different economic points like employment, non-farm jolts, CPI, PCE, et cetera, are going to have to fill in the gap between March 19 and May 7. And it's all leading to will they or won't they for June 18. If Powell, and here's the most important part, if Powell does not want traders and investors out there broadly expecting that they're going to cut rates, he will talk this down. He can see this. They know what this is. This is perfectly publicly, freely available information. He can see what the expectations are. So when he starts his meeting this Wednesday, he might see collectively there's an 82% cumulative expectation that rates will be lower in June. And if he's talking to his buddies in the Federal Reserve and says, wow, they've got that way off, we're gonna cut sooner, for example, he will ratchet up that more accommodative dovish talk. All right, if he thinks, gosh, they're getting way ahead of themselves, this is not what we're going to do. We're not going to start in June. We're probably going to start in July. And believe me, gang, they have a pretty good idea of what they're going to do. Then he'll talk it down. He'll push those expectations out. So this is more like a two-way radio. We collectively, traders and investors, are telling Powell, we're expecting you to cut in June. And Powell might say, nah. And that's where the battle is going to happen on Wednesday, this push and pull. And that's where, frankly, the equities are going to be susceptible to movement. Now, if you've been following any of what I've been saying the last couple of weeks, you know that there's a bigger question that I think a lot of us are asking. Bullish or bearish, right? Bullish or bearish? And I guess the answer really is that I want to get across in this Q&A is it depends on what time frame. I'm not talking about day trading, and I'm not talking about hourly time frame. Every single day on a shorter time frame, 5 minute, 1 hour, that's not the time to dig your heels in and say, I'm bullish on those short-term time frames. You could actually vacillate between those every day, even from AM to PM part of the daily session. That could change constantly. What we're really talking about is a juxtaposition of the downtrends that we're seeing in a lot of stocks, and that we're seeing in a lot of sectors, and that we're seeing in a lot of the indices, versus the uptrends, or at least mostly bullish chop that we're seeing in a lot of the indices, sectors, and stocks. So case in point, one of these that I've been talking a lot about has been communications. Communication is in a beautiful weekly uptrend. It's very weak on the daily time frame, a time horizon of, say, days to weeks, a weekly time frame of a time horizon of weeks to months, or frankly, months to years. So days to week on the daily in terms of how long I could be in the trade, or the trade life cycle or the time horizon, whatever you want to call it. And on the weekly, it's months to years. And this is one of those places where on the dip lower, I want to buy XLC. That's the plan. We're starting to look at opportunities to get long on all these pullbacks that are happening where we could set up positions for a far longer, I don't want to call it buy and hold because I'm not a really big fan of buy and hold. But if buy and hold is sort of this marry the stock investing type mindset, the other mindset, which I think a lot of traders have, but they don't necessarily call it this, is a position trade. And a position trade could last years, decades, right? It's just a matter of buying at a particular price when price gets down there, knowing that this is where you can manage risk from. You're not chasing something higher. At least that's not the point of a position trade. So if I'm looking at a position trade on XLC and we're trading at 105, 106, I'm not going to buy it at an all-time high. I'm going to buy it, like you can see here, the week of August 5. You can see here, this is the week of September 9th. This was the week of March 10th. So if you think back on an entire year, this is only really the third mean reversion we've had. It's a far slower style of trading. I'll call it a trade. It's not a buy and hold. A trade presumes certain things that investments don't. A trade presumes there's a particular price, that there's a specific amount of risk to the account that I'm willing to take, and then ultimately I have a target. And even if that target is time, that's still a target, right? Raghee, you have targets for your longer term kind of position trades? Of course, a lot of times it's time. It's not that I'm waiting for XLC to go to 155 or 200. It's really more of a time entry. So these are things that are happening right now. And that's where if we can separate our swing trading from our position trading, our daily time frame opinions from our weekly time frame opinions, right now is a really great opportunity to do a little bit of both. On Friday's free video, I also mentioned that the Friday action is very different than Monday, Tuesday, Wednesday, Thursday. And there's an old saying, it's called don't fade Fridays. In other words, if going into the latter half of the day, say after the lunchtime doldrums, after 1:30 Eastern, going into the last hour of the day, if you're watching whatever symbol you're looking at, and you're seeing it stair step and stair step and stair step into the close, chances are we're going to get follow through on Monday. Chances are that the Sunday open, which is something that we're looking at right now, is going to be bullish. If we're closing at or near highs, look at the gap up here. This is why we don't fade Fridays. Now, what would be a fade? A fade is, we're heading higher into resistance. We've got a downtrend. Let me buy puts on Friday. It's going to be far better, more often, to buy puts, say Monday or even Tuesday after a strong Friday. There are a lot of reasons for this, but for the most part, you can look at different things like intraday seasonals. You can look at different price patterns. One thing that happened on Friday is that the minor low of March 13 with a breakout at 56.23 was broken into the close. That would be a minor low that would really signal a brief period of bullish momentum, even if in a downtrend, right? So these are little things that, do I want to look at Monday with the same psychology as Friday? Well, let me ask you, do you have on Monday when you show up to work the same psychology that you do on Friday? No, most people don't, right? Not everybody, but most people don't. So the beginning of a week is very different than the end of a week. The beginning of a day, different than the end of the day. Same thing goes for the month. Same thing goes to the quarter, which brings me to one more thing. The end of this quarter is going to be a big one because this is where usually at the end of a quarter, folks who manage huge sums of money, asset managers, position managers, portfolio managers, they're going to think about the next 90 days. They're going to think about, am I positioned in places where when I have to show a report card at the end of, say, June, if I have to show my clients my report card, what have I made for you, right? Is what they're thinking about their clients, the question that will be asked. What can I do in Q1? What can I do in Q2 that come December, the end of Q4, I can say, see, this is where I put you in and this is where we are now. a lot of times these pullbacks are really great opportunities, because if someone's trying to grow an account, it's a whole lot easier to buy something at the basement level, the first floor, the second floor, the third floor, than it is to buy in the penthouse and hope that we keep going up into the clouds, or to buy on the 30th floor of a 34-story building and just hope that we keep going up. There is a value to buy the dip. And in certain places, what we're looking for is that opportunistic thinking by people who manage money, who have a far longer opinion of, hey, do they care what happens over the next few hours? Are they day trading? Gosh, no. Are they looking for the next few weeks? Gosh, no. They're looking to dig their heels in so they can show a good return at the end of maybe Q2 or the end of maybe Q4. So there is that longer term. And by the way, the money that pushes into the market does tend to be a little bit more long term. Retail traders tend to be very, very twitchy. They're in, they're out, they're in, they're out, and they wonder why they're losing, right? Longer term, it's a lot more sedate than you'd think. Not everybody, but there is a lot to be said about if someone's building a position portfolio, they're not looking at the next 2 weeks. It's not that fleeting a position. So why not take advantage of some of this? So again, juxtapose the daily to the weekly, juxtapose the trends that are on each, and then take a look at the economic calendar and ask yourself, all right, what are the things that are happening on the economic calendar that could change sentiment, make it more bullish, make it more bearish? Again, longer term, I'm bullish. If you were to ask me 12 months from now, and I remember I put this out as a tweet on my or post or whatever they call that now on X. I'm a huge fan of. I love the cocktail party that is the conversation here. If you're not thin-skinned, if you're not overly emotional, this is a really cool tool to see what sentiment is doing, because you can see someone post an idea and then people lose their minds and start to comment. It's really interesting. I'm not super engaged, but I do post things from time to time, and you'll see they're a little bit more mindset, education based. But I love the cocktail party that is this site. And there's a lot to be said about social sentiment. Social sentiment is usually at the opposite end of behavior. The most bearish social sentiment usually comes at the bottom, and the most bullish social sentiment usually tends to come at the top. That's the way it is. So what a cool way to kind of see what people are thinking. And people right now, they are very worried. We're getting things like recession thrown around. We're getting words like, oh, this is the beginning of the end, and very bearish, very pessimistic, fearful type conversations happening. Well, that's usually, I'm not saying instantly, that's usually a precursor to bottoming formations. So that's what I want to find, usually in a weekly time frame. And then if you take a look at Mag 7s and things like that, I would start with the NASDAQ before making any broad suggestions about the future of Apple, Microsoft, Amazon, Google, Meta, NVIDIA, Tesla, Broadcom, any of those. I would keep an eye on the NASDAQ, and then I would keep an eye on the individual sector. The weakest sector right now, where are the bears? Bears versus bulls, bullish versus bearish. This is a very bearish sector. It's one of the weakest sectors out there right now. In fact, we built a watch list in the Sector Secrets Mastery. I'm sorry, I'm looking at my notes here. We built a watch list on the Sector Secrets Mastery that kind of aligned the weakest sectors with the weakest stocks. So rather than thinking a strong stock is going to roll over, we're going to focus on weak stocks bouncing, buying puts, and moving lower. Two really good examples within the consumer discretionary XLY is Amazon and Tesla. And so as I'm sitting here in the office on a Sunday, I usually spend about an hour, maybe 45 minutes in this room on a Sunday, getting ready for Monday. And I want to take a look at the positions that I have. I want to take a look at all the trades that I've taken thus far in March. In fact, one of the things that we did in the Sector Secrets Mastery, and I do this regularly, is I send out, we have a saying, every entry, every exit, every day. So if I've entered a trade, I will share with members, right? It's always going to be based on the alerts that we sent out. So I send out an alert. Later on after the close, these are my fills based on that alert. And what I chose to do this month is just send a tally of everything that we've done. Take a look at every alert that I've sent out and the prices that I got filled at, where I scaled out, where I got closed. And this is what transparency is, gang. Transparency isn't an alert that says, hey, I bought this. To me, transparency is, hey, Rag, show me an easy way to follow what you bought, what price you bought it at, where you took profit, and where you finally closed the trade out, or where you bought it, where you took a loss, right? And every single entry, right? Not the lowest one that I bought at, or the highest price from which I bought, for I was shorted at, but every single price. So I can get a good idea of how we scaled into a trade and where you scaled out. Those are things that we do. Another thing that we do is I send out alerts that are setup alerts. I think a fill alert is about useless. This is what I just did. Good luck to you, right? The whole idea is, as traders, trade's about to happen. If I don't see a setup coming, right? If I don't see a trade coming, that's a gamble. I don't want to do that. So I'm going to see what trends are heading lower, what price that I want to buy a put from. Once I know what that price is and I like the setup, I send out an alert. Doesn't mean that I know price is going to get there. It just lets everybody be on a level playing field to make their own decisions, manage their own risk, understand position sizing. Yes, I give you a formula for all that, but it does take a little bit of time to process, right? So by putting out the setup alert, everyone knows, Rag, for example, is looking at, whatever it is, a Tesla, for example, or Amazon. We're looking for long puts on Amazon. Are we going to trade up into a zone from where I want to trigger those long puts? And I send out those triggers. I send out that trade idea, that plan. And if the plan comes to fruition, if the plan reaches the price levels from which I know I want to buy that put, great. If it doesn't, we'll go back to the drawing board and build it out again. And this is the way we have to think about trading. What are the setups that we see coming? And can I alert out, even if you're doing this for yourself, are you sending yourself the idea and then you're using your charting platform to put alerts out there so that, for example, if XLC gets down to that mean reversion, you've got an alert saying, hey, XLC is at 95.30. You wanted to buy this thing at, say, 95.20. I'm giving you a heads up. TradingView can do that. Thinkorswim can do that. Maybe you're bearish on Amazon and you want your platform to say, hey, Rag, we're up at that Darvis resistance at about 201. You wanted me to let you know. So here's 290. We're 10 cents from that level. That's the way you want to look at your trades. That if certain prices are reached, whatever that series of confirmations you need are then now happening, that's when you want to put on that trade. All right. So again, that's really a wrap. That's what we're taking a look at as we go forward into tomorrow. If you have any questions, I'll be right back here tomorrow at Charts and Coffee. And let's see. Ken asked, do I analyze the currencies and are they tradable for both long and short? Yeah. Ken, you can trade Forex for that. Yeah. If you want to trade currencies, there's a couple ways you can do it. There's Forex, of course, right? And then if you want to trade options on futures, those are also pretty darn liquid. And there are a handful of majors, whether that be 6E, 6B. There's a number of futures contracts on the majors, which is generally a currency that trades against the US dollar, like the British pound, the euro, the Japanese yen. So yeah, they're tradable in both directions. Sure. And can you swing trade them? Absolutely. It's a matter of finding similar setups to what I'm talking about here. So if I were to show you the 6E, I use the same indicators, and you can see here, 6E has been bullish. See that? Green in the gray, green in the gray, green in the gray. These are all long setups since the 6th after this particular currency took off. It was very bullish, trading above the typical price movement range in abnormal volatility. We've actually been in pretty normal volatility every day since the 6th. So a green candle in the gray zone? Absolutely. All right, gang, be good to each other. I'll see you tomorrow, same time, same station.